Good evening, ladies and gentlemen. It gives me immense pleasure to welcome you all to this special session on a subject that is shaping the future of international taxation. Enhancing global tax transparency, the role of exchange of information. Today, we have the privilege of being joined by some of the most respected leaders and minds in our profession. First and foremost, may I extend a warm welcome to CA Sanjay Agarwal, sir, Chairman of the Committee on International Taxation, whose leadership and vision continue to guide our fraternity in navigating the ever changing landscape of direct taxation. Sanjay Kumar Agarwal, sir, is a man of professional wisdom, vision, and strong technical skills. He started his career in 1986, a blend of erudition, experience, foresight, and professional excellence, worth emulating. A fellow chartered accountant from Delhi, he has been in practice over 36 years. He has also served as chairman of NIRC of ICAI in 2004-5, executive member 2005-6, and treasurer 2006-7. CA Sanjay Agarwal sir has shown his professional skills and acumen in various tasks and responsibilities assigned to him both at the regional and council level. We are equally honored to join us here with us, Mr. S.P. Singh, sir. Welcome, sir. Welcome, S.P. Singh, sir. Welcome, Chairman, sir, for today's session. I would
Thank you.
request, I would welcome today's speaker, CA Karthik Natarajan, sir. Before I proceed, I would like to have our address from you, Chairman, sir.
Thank you for giving the nice introduction, CA Sneha. Very good afternoon to all the participants and esteemed speaker, CA Karthik Natarajan ji, my vice chairman who's there in the council meeting. We have tomorrow council meeting at Pahalgaon for the purpose of showing the national solidarity. The entire council is going to the Pahalgaon, and we'll have 3 days council meeting there itself. My vice chairman is there, CA Chandrasekhar Chitle sir, and my mentor in the committee, CA Shri SP Singh ji, and the participant of this topic, which is not so common, but in today's world where people and business operate across borders, tax transparency is more important than ever. It has increased. The countries share tax information with each other like anything, like just click of button. And the informations is today is, you can say, the data. Everywhere it has become the data is a new oil. So the aim of today's session is to help you understand how countries exchange information, the tax system they use for these exchange information, the challenges which are involved to them, and because this tax information is private and sensitive, it can only be shared according to the strict rule in both international agreement and local laws also. Information is shared only between the officials, competent authority. What is competent authority? It is being defined, but the competent authority, I have dealt in some of the cases that it is not the principal commissioner or the assessing officer. It is the in both the countries, the competent authorities is the defined one, as these will be the competent authority. What will be the exchange of information? In short, EOI. What are the types of the exchange of information? There may be information exchange which are based on request. They are short in called EOIR. So these information depend upon the country to country. For example, if I want to obtain an information from US on a specific case wise, then it will be a on request basis. But there are certain information which are given on spontaneous basis, So one country finds that tax related information that might help the another country, they share it voluntarily. The third type of the information is automatic exchange. So these are the various types of the informations which the two cross countries or more than cross countries they share. Initially, when in 2000, I think 18, when I started looking to these things, I got some information about the HSBC Bank, which has come to the various taxpayers, tax collectors also. So at that time, when I was searching at that time, we could not find any literature which was available in the public. Only there was one exchange information manual which was even officially not available that I could lay hand and then we could have lead. So at that time, we could find that Karthik Natarajanji has developed something and your issue at that time we tried and we published one publication which has seen the light of the day and he is the author of that particular publication. That is why today we thought it that none other than CA Karthik Natarajan will do the justice to this topic. So we need to understand also why this exchange of information should be known to the consultants, to the professionals, and why these are matters to the taxpayers. Because the information, when it comes, if it is a hidden one, then you will be in trouble because of Black Money Act will be there, or you will be prosecuted. So you must know that where you are standing. So today, the speaker will try to explain you A to Z about the topic of the today, and the for the purpose of moderation, see Sneha Amanat will take care of the lot of the question. Sir, as I always request that we should keep at least 15 minutes, last 15 minutes for the question answers, because if we are not in a position to give the answers to the queries of the participant, then it means we are not justifying our role. So I will request both Sneha and Karthik sir to keep reserve and keep a tab on the Q&A box. And I request all participants to put their queries in the query session, and we'll try to see that we cover everything. So with this, I once again uh, welcome the participant. Also, I am thankful to the Karthik sir for sparing the time. So, participants, this knowledge you will not get anywhere. I am sure of it. So, I encourage the participant to take active part in the discussion. With this, thank you very much for the giving the time, both SP sir and the office in organizing this particular webinar. Thank you very much. Sneha, over to you.
Thank you so much, sir, for your brief on today's session. It was very insightful on able to understand what we may look forward for upcoming session from Karthik, sir. Also, thank you for your insights and how you feel this is very integral part for an international tax development and how it is for us consultants as well. We are equally honored to have with us C.A. Chandrasekhar Vasant Chitale, sir, Vice Chairman of the Commercial Committee of International Tax, whose expertise and strategic insights have been very instrumental in shaping policy recommendations and capacity building for our members. I would request him to provide his insights on today's session, sir.
Well, thank you, Sneha. I think much inputs have been provided by our worthy chairman, Sanjay Agarwalji, and I am beneficiary of that information. As children, we always fancied that so-and-so rich person has got account in a Swiss bank. And what really was material, maybe we did not realize at that time, but today as we realize that when you open a secret account in Swiss bank, that information is not shared with anyone. So maybe the money which you have not accounted for or which you want the world at large is secret from all the regulators, everybody. Maybe that was one destination, and then there were certain other destinations. So that was uh, aspect which was fancied maybe a couple of decades ago. But thereafter, there has been awakening amongst all the jurisdiction, particularly tax jurisdiction, that it is not a point of honor holding a tax shelter to ill-gotten money which has escaped the taxation. Maybe it is not also in compliance with the rules and regulation of the jurisdiction. And there has been a discussion amongst various countries that there should be sharing of information so that these malpractices can be curbed. And today we are at the cusp of the situation that not only sharing of information, but maybe at all jurisdiction there should be some minimum tax so that the country of destination will not be selected because of its tax effectiveness, but maybe because of its suitability as far as geography, etc. is concerned. Friends, you will recollect maybe a few years ago, direct tax code was tabled. And at that time, at Institute, we had rounds of discussion for making suggestions on direct tax code. And at that time, the wealth tax was proposed on bank accounts held by residents of India and foreign countries, whereas bank accounts in India were exempt from wealth tax. And at that time, in discussions, we said that why this particular provision has come, and we opposed it. But there were representatives from regulator. They said, please hold on your objection. During lunchtime, we'll informally discuss, and then still, if your objection sustains, we will note it. And during lunchtime, they informed that if we ask any jurisdiction, okay, how many bank accounts are being held by persons of Indian origin residents, and please give us the details. So those jurisdictions state that unless you demonstrate that there is non-compliance with law, we will not share the information because maybe they have that particular safety security available from us. So unless you demonstrate such things, we will not share the information. And since we want that information, we can tell them that we want to know whether the wealth tax has escaped on that particular money. And we appreciated the thought process and did not object. Of course, the direct tax code did not see the day of the light. uh, we have also with us as far as exchange of information is concerned, Honorable SP Singh sir. So from us, the information keeps on receiving to the committee. The exchange is really one way. We are beneficiaries of that information, and then maybe we exchange it with the members at large in the form of publication, in the form of other things. Uh, Karthik Natarajan, I have seen his profile. He has a vast experience in this particular field. So, as we appreciate that this particular aspect is more for regulators to address that how to get the information, but ultimately in the interest of the country. And that is the aspect which is dealt with at macro level. But then the practitioners who are participants, like me, maybe chairman, would also like to know and inform the stakeholders that if you try to be too smart, then there is a government which is over smart. And to that effect, let me share an anecdote and close at that. You know, in old days, there was a Salim who used to sell caps, and he went through the jungle. He slept there, and all monkeys took the cap. So he put the cap on his head and put the cap down. So monkeys imitated, and every monkey threw the cap. He collected and went. Today is not the era of Salims. It is his grandsons who have come into surface. So while his grandson was passing through the jungle, maybe not as thick as in Salim's time, but he was going to pass through that jungle. So Salim told, please don't sleep in the jungle. This was what happened. But this is Gen Z. If they listen to earlier generation, then they won't be Gen Z. So he also slept. His caps were stolen. So he knew that his grandfather has told that if you put the cap is stolen, you put it on head, put it down, monkeys will throw it. So he gently put the cap, threw them down. He did it 2 3 times, nothing happened. Then he looked upwards that whether monkeys were watching. Yes, each and every monkey was watching. Then he again violently put the cap down. Still nothing happened. And then one monkey answered, Sir, we also have grandfather. So that is the case for stakeholders to know that if you try to play smart, maybe your grandfather, there is a grandfather at government who will catch hold of you. So it's really indeed a eye opener for all of us. And if, as a ICI, if you want to suggest any tightening up, maybe we'll be very happy to do that. And I thank Karthik and SP Jain for sparing time. Thank you.
Thank you so much for briefing on the session and giving us the need why we need this session, sir. And you have also given a beautiful anecdote to start off with. So thank you so much. Now I come on to our next person who's joined us with his expertise and who has made his contribution to the Committee of International Tax, our own SP Sir Singh. SP Singh sir. He is an ex-IRS who is a senior advisor for the Committee of International Taxation. He is popularly called SP Sir. Now, he has been with IRS with more than 2 decades. He has held various positions, including Director of Income Tax, International Taxation, Commissioner of Income Tax Appeals, participated in negotiation of tax treaties with more than 30 countries, and he has taken part in mutual agreement procedures. He has represented India in several international conferences and presented papers. He was a member of expert group on transfer pricing constituted by Ministry of Finance for drafting the transfer pricing regulations. He represented the Income Tax Department before the Authority for Advance Ruling in several cases. Thank you for joining us, and we would want to get the great wealth of knowledge that you have to share with us for today, sir. And please provide your insights for today's session.
Thank you, Sneha, for such a nice introduction. It's always, I mean, at my age, it is the praise which is the most, valuable thing. So, and coming from you, I cherish that. Sorry. Hello.
I can hear you, sir.
You're audible.
Can you hear me?
Yeah.
Okay, fine. So thanks, Sneha, and respected CS Sanjay Agrawal ji, Chairman of the Committee on International Taxation, CS Chandrasekhar Chitale ji, Vice Chairman, our distinguished speaker of the day, CA Karthik Natarajan ji, the moderator of the seminar, CS Sneha Amarnath ji, CA Saparna ji, and all esteemed participants and the team of Committee on International Taxation. I am honored to have this opportunity to share my views on very important topic. And as we all know, the globalization is happening, international trade is expanding. In such a scenario, the tax policy makers have 2 imperatives to meet. First, fostering cross-border commerce by eliminating or mitigating double taxation and combating tax evasion through robust exchange of information mechanism. These 2 objectives are sought to be achieved through suitable bilateral and multilateral agreements. And Natarajan ji will talk in detail about this. In the evolving framework of international taxation, exchange of information has become a central pillar of global tax transparency, cross-border cooperation, and effective enforcement. Its emergence is linked to the rapid growth of cross-border commerce, increasingly complex corporate structure, and tax planning strategies which exploit information asymmetry between the tax jurisdictions. The concept evolved from limited cooperation clauses in the early bilateral treaties to the present-day comprehensive multilateral standard. The whole thing was started by the League of Nations, and over time the OECD, that's the Organization for Economic Cooperation and Development, has assumed the role of principal standard setter, with Article 26 of the OECD Model Tax Convention serving as the primary treaty template. The United Nations Model Tax Convention offers a parallel provision adapted for developing countries. Friends, the global momentum has been reinforced recently by G20's endorsement of transparency standards, the Financial Action Task Force emphasizing on the beneficial ownership reporting, and the latest and very well known initiative by United States on the Foreign Account Tax Compliance Act, that is FATCA, which has spurred worldwide adoption of automatic exchange mechanism. And as Sanjay ji has said, that exchange of information now is happening in three forms. Exchange on request, where specific information is sought for a particular case. Second one is spontaneous exchange, where one jurisdiction shares relevant information without a request. The difference between the two is that the first one is on a specific request, whereas the second one, the sender takes the decision that a particular information may be very important for the recipient country and shares that. And the last one, the automatic exchange of information, which is a systematic transfer of predefined information on a predetermined regular intervals. Some countries are very active, some are not so active, but OECD is trying to make this as a real instrument for sharing information. The global standard on automatic exchange of information, which has been developed by the OECD and is endorsed by G20, is implemented through two important instruments. First, the Common Reporting Standard, and second, the Multilateral Competent Authority Agreement. The first one is the tool, whereas the second one provides the legal arm for all the process. Over 120 jurisdictions now exchange information annually on financial accounts of non-residents. In very recent time, as recent as 2024-25, the CRS, that is the Common Reporting Standard, has been expanded to include crypto assets and digital platform income, closing the potential loopholes arising from decentralized finance and the digital economy. This reflects the global resolve to keep tax transparency aligned with evolving technologies and financial instruments. India has all along been very active participant in this framework. The statutory foundation for the automatic exchange of information is provided by certain provisions, 285B in our Income Tax Act, which requires taxpayers to furnish information in a specified format to the tax department. And the Central Board of Direct Taxes is enforcing the compliance through penalties for non-reporting or inaccurate reporting, and issues circulars and other form of guidelines as and when required. Friends, the exchange of information delivers multiple policy benefits. First, it deters offshore tax evasion, strengthens the capacity to detect and investigate concealed income. It supports anti-money laundering efforts and enhances voluntary compliance. Equally important, it fosters public confidence in the fairness of the tax system by ensuring that taxpayers with offshore assets are subject to the same level of investigation as a domestic taxpayer. So it gives the level playing field. Nevertheless, and this is very important, its effectiveness depends on several factors. Timely and complete responses under the exchange of information on request, the quality and usability of automatic exchange information data, and strict confidentiality safeguards to maintain mutual trust among jurisdictions. Meeting these requirements demand ongoing international cooperation, domestic administrative capacity building, and periodic legal updates to address the ensuing risks. In conclusion, exchange of information is no longer a peripheral or technical provision of a tax treaty. It is a fundamental legal, administrative, and policy instrument essential for safeguarding national revenue in the interconnected economy. Its continued development will remain integral to the future of international tax administration. And today we will hear from C. Natarajan ji about various forms of development and various forms of implementing the exchange of information. And I'm sure it will be beneficial to everyone. Over to you, Sneha.
Thank you, sir. Thank you for briefing us with the history of how important the exchange of information is in today's world, with the insight on the statutory implications and how we are bound by it. So now moving on further, today we have with us our distinguished speaker for the day, CA Karthik Natarajan, sir. Many of you know him not only as an eminent practitioner, but also as a prolific author and thought leader. His work, Growing Importance of Exchange of Information, a Comprehensive Study, is a remarkable blend of deep technical knowledge and practical clarity. And today we have the rare opportunity to hear directly from him on this topic. So, CA Karthik Natarajan, sir, is a fellow member of the Institute focusing mainly on the direct indirect tax representation and litigation space, performance evaluation of Board of Trustees, directors, regulatory proceedings related to FEMA, FCRA, Black Money Act, PMLA, Benami law, insolvency law, and practice. He is also a resolution professional, part of Indian Institute of Insolvency Professionals of ICA, and a member of Insol International UK. Thank you for joining us, sir, and thank you for your time. So we look forward to a great session today. Over to you, Karthik, sir.
Thank you, Sneha, for the flowery introduction. Thank you to our Committee on International Taxation for giving me this opportunity. Thanks to CA Sanjay sir, as also to CA Shekhar Chitle sir, whom I have adored since the time I started practice way back in Pune. Thanks to SP Singh sir. May I now request the presentation to be started? SP Singh sir, thanks so much for the outline. And with that, we enter the topic for the day, which is enhancing global tax transparency. And how has exchange of information, EOI, how has it played a role in ushering in a new wave of increased tax revenues for jurisdictions, as also promoting voluntary tax compliance? Yeah, next slide. Next slide, please. Is the slide on?
Yeah. Share it again.
Yeah. Yeah, go to the next slide. Can you present it? Thank you. So friends, the topic of exchange of information over the next 6 or 7 blocks, we will try to see them. I have, I think, about 35 to 40 slides for the presentation, spanning around an hour or so, and then leaving ample of room and time for exchange of information amongst us participants / question and answers, as we know it commonly. Now, in the first block, we try to see what was the need for having this information exchange in the first place. What has been India's experience in dealing with this tricky and taxing subject? What have been the developments which jurisdictions have had over the so many decades, perhaps even a century plus, of exponential growth in international tax and trade? Then we also spent some time on the Article 26, of the Model Tax Convention. Article 26 deals with exchange of information. The tax conventions, as you know, seek to allocate taxing rights amongst jurisdictions. They seek to prevent double taxation. They also strive to promote tax avoidance. They are against tax abuse, right? And we also then will try to spend some time on the common reporting standards, which was outlined at the initial introductions. That's the global standard, golden standard now, which we have adopted, facilitating or paving the way for automatic exchange of information. I do not know, no longer India needs to ask for certain information that should come automatically. Right. This was way back in 2014. We started this, and India is also a very important role player in this CRS program. We will see all that in the ensuing slides. At the end, perhaps we will touch upon befittingly, since we are doing this webinar from India, the Indian context and what is the exchange of information framework that Indian tax regulatory landscape has on offer to us now. Next slide. Well, an important obiter, the softer the state is, the greater the likelihood that there is an unholy nexus between a lawmaker, lawkeeper, and a lawbreaker. This is Honorable Supreme Court speaking in a very landmark case, 2014 somewhere it came. This was in the case of Ram Jethmalani versus Union India. Basically, a writ petition. This was an important case. Why? Because a writ petition was filed before the Honorable Supreme Court of India by several prominent citizens coming under the banner of some organization. Their stated objective was to bring about changes and betterment in the quality of governance and functioning of all public institutions. The immediate backdrop to that, leading to this petition, was the treasure trove of information which came by the Panama leaks, and even before that, the government of Germany had access to data pertaining to LGT Bank, Liechtenstein, about news reports that huge amounts of tax outstanding demands were there from one Mr. Hassan Ali Khan, from another one Mr. Kashinath Chapuria, and so on. And it was a very well watched proceedings at the Apex, before the Honorable Apex Court. The government of the day that time pleaded that it was a very extremely complex problem that required cooperation of many jurisdictions and an internationally coordinated effort. Because here you are talking about Indian wealth supposedly or allegedly slashed abroad. You can't establish it unless you have the information. I am now trying to establish the need for information exchange. So the Honorable Court in that case had explained the importance of information obtained from foreign governments, that if there was some information and knowledge that such vast amounts of money may have been stashed away in foreign lands, foreign banks, then it implied that the state had the primordial responsibility under the Indian Constitution to make every effort to trace the sources of such monies, not just trace, but also punish the guilty where such monies have been generated and or taken abroad through unlawful activities, and then finally bring back the monies owed to the country. Yeah. Where is the presentation? नहीं मेरा कैसा है मेरा so it's happening from just one sec. Just one sec while the team tries to do that.
Yeah, Natarajan Sahib, it has come.
1 minute.
We can see that.
Yes, I am also back. Yeah. So thus spoke the Honorable Supreme Court in this matter, setting the context and the need for exchange of information. Next slide, please. Yes. Friends, I have some data for you. When they measure something called an openness index, which is actually a measure of the total international trade, which is export plus imports, as a percentage to gross GDP, gross domestic product, it was 2% somewhere around the 1500s. Somewhere in the beginning of 19th century, it became about 10%. Slowly, it had clawed its way above. Today, in 2020, it's almost 52%. Now look at the quantum leap in international trade. With that, world has now become a small marketplace, interconnected. Now, when you have porous economic borders, there is but naturally cross-continental flow of money. And when that happens, you are now looking at various opportunities for tax arbitrage, for cost arbitrage. That in fact has also spawned the creation of new organizations such as multinational corporations. And when you have this kind of a setup, it is ripe for allowing profit maximization through cross-border tax evasion. Historically, the governments have had a very, very delicate conundrum. They face this dilemma. On one hand, they want to encourage foreign investment, and if they were to do that, they have to create a liberal foreign tax, liberal domestic investment climate. But whilst they do that, they also are supposed to protect their tax base. And we have also seen in this period the emergence of certain jurisdictions known as the tax havens. Basically, tax havens are characterized by two broad features. One, they will have very less or nil taxation, and they will back it up usually by a very lax or liberal regime when it comes to accounting principles, accountancy, the keeping of books of account, the taxation itself, the banking secrecy. That will be most liberal in those kind of jurisdictions. And now when we have this steady mix of government's dilemma with the tax haven effect, you are now looking at a race to bottom. There are jurisdictions competing amongst themselves for capital flows, and that will create a situation of information asymmetry, because there will be jurisdictions who will seek to have jurisdictions which are historically lax when it comes to maintenance of historical records. They may not be able to provide information, especially about the residence or the beneficial ownership when it comes to that. And what is the purpose of a tax treaty? We have just seen it is not only to prevent double taxation, it is not only to avoid that, but also to prevent tax evasion, right? And therefore, only if we have a healthy and robust climate of exchange of information will we be able to curb this menace of tax evasion in all its entirety. Yeah, that is the powerful need for this kind of an exchange of information program. Next slide, please. And how has India's experience been? Well, tax officers, especially a couple of decades ago, will say it was well nigh impossible to make a suitable and a proper assessment of taxes of some people who have cross-border financial transactions. Well, India per se itself also went through a process of prohibitively high personal and corporate taxation, around 97% at some point of time. Now, as a result, it led to various dubious, means of trying to hide the income or stash that actually led to stashing of ill-gotten wealth abroad. And naturally, the residents are here, but the wealth has gone out. Now, there will be linkages when it comes to proper assessment of taxes, especially from the income tax standpoint. And then the income tax officer, learned income tax officer, is left with a stone wall how to get the information. Because for once, kindly understand, we are dealing with a plethora of jurisdictions. There are a host of definitions worldwide. What we see as income may not be income as far as another jurisdiction is concerned. What we see as dividend may be interest in another jurisdiction. If there are differences as simple as these, imagine how difficult it must have been to try and receive the information, credible and relevant information for tax purposes. And we will also see in later slides things such as what is necessary for tax purposes, or whether it is foreseeably relevant. We then made it liberal that information which is foreseeably relevant also can be given. So there were great amount of difficulty faced by our tax officers, not just India, it was a global phenomenon. Even the mighty US has also been a victim of this information gap and the difficulty coming associated with that. Then, of course, remains the ever-pervasive, all-important bank secrecy clause. Can we go to the next slide, please? The bank secrecy clause especially means there are jurisdictions who will not share information because sharing of, and what kind of information? Typically, it all somewhere or the other lead to banking transactions. And in some jurisdictions, including the famous Switzerland, which our Shekhar Chidle sir talked about at the opening, Swiss Bank. What is Swiss Bank? Swiss Bank is nothing else but a bank which is not bound to share client confidential information, not just because of their whim or their liking, it is because it is criminal to do so. The law in Switzerland, Banking Secrecy Act, 1934 there, has made it criminal to share such information with anybody. And so therefore, that is often touted as a kind of panacea to try and hide client confidential information. Historically, world over, banks and especially tax havens do this. They use bank secrecy as a wheel to try and hide the ongoings, the transactions at the back end. How has it been as far as India is concerned? Well, historically, banks in India have also maintained strict confidentiality about their client confidential information. In fact, that is a given. However, we have made some broad exceptions. That is, if it is mandated to be disclosed under some legal mandate or court order, or if it is in the nature of a clear public interest. Banks will also share confidential client confidential information if it is in their necessary legitimate interest, in their own interest it is necessary to do so, or if the client has voluntarily consented to do so. Now, these were the general principles which were framed in the famous case Tournier versus National, Provincial and Union Bank of England 1924 case. It's an English case. Here we also had this Honorable Calcutta High Court in Shankarlal Agarwala versus State Bank of India case 1987 somewhere, where it was upheld that the banker was under an obligation to secrecy. Yeah. Subject to these four exceptions. This is notwithstanding the fact that in Reserve Bank of India versus Jayantilal N. Mistry, the Honorable Apex Court, the Supreme Court of India, in the context of Right to Information Act 2005, it had held that the RBI did not have a fiduciary relationship with banks and financial institutions, and therefore the RBI gave a landmark decision upholding the direction of CIC, Chief Information Commissioner, to disclose inspection reports of RBI and names of willful defaulters. Yeah. Somewhere in 83, the Indian Parliament, Honorable Indian Parliament, enacted the Public Financial Institution Obligation as to Fidelity and Secrecy Act that, as the name suggests, provides for obligation of a PFI as to fidelity and secrecy. In fact, Section 3 of that, Section 3(1) will state that a PFI will not divulge any relation relating to its customers except in circumstances in which it was necessary to do so, in accordance with the law or practice and usage or customary amongst the bankers. So that's the context of banking secrecy in Indian context, is Indian environment. Next slide, please. That brings us to how has then exchange of information evolved. As was outlined at the beginning by our chairman, sir, it was on, we have some more formats, of course. We have exchange on request, okay, specifically requested, then we have to give, this was that letters rogatory wala route, which used to be adopted by the learned income tax officer here in India. Now, if he needs an information relating to a bank transaction or a bank account of, let's say, an Indian tax resident which he is assessing, but the account is domiciled in, let us say, United States of America, then he had to write a letter rogatory through his proper channels, through the Honorable CBDT, then who in turn will pass it on to the corresponding authority, appropriate authority that side, the IRS, the Internal Revenue Service, and it would get percolated to the relevant bank / tax authority / custodian who has this, who is privy to such information, and then the reverse process would begin, ultimately reaching the learned Indian income tax officer. That is the exchange on request basis. We also have now the automatic exchange of information, which forms bulk of the topic today that we will be covering in subsequent slides. Spontaneous exchange, the moment some information is laid hand upon by the domestic tax officer, he or she will push it to the foreign tax jurisdiction spontaneously, no need to wait for it. Maybe this information is something which might be of use clearly for appropriate tax calculation in the other jurisdiction. Tax information examination abroad and simultaneous tax examination. These are again advanced concepts which are more like cooperational tax examinations. So tax authorities from both countries, they can allow, so either CBDT can go to IRS and do some examinations or questioning, or similarly it can be coordinated between CBDT as well as the IRS. The concept of AOI is automatic exchange is more preferred because it has kind of standardized the flow of information. It has made it more certain. Here in India, whoever are the signatories, especially like here in India, we are now certain that we will receive ABC information about financial transactions of any Indian national having bank accounts, let's say, abroad, right? It could be peak balance, it could be name, tax identification number, it could be the dividends that have been received and so on and so forth. And because this is now automatic, it is facilitating proactive and large-scale information exchange. It is system-driven, yeah, and it has actually promoted voluntary tax compliance, and thereby it has deterred potential tax evasion systematically. Next slide, please. Somewhere in the early 2009, somewhere, that time, G7, as used to be the rich man's club, coming in the backdrop of the Lehman Brothers downfall, and then the various scandals which rocked, Enron happened, there were various scandals which happened. Thereby, the G7 nations took note and decided that it is very difficult for themselves to tackle the larger menace of tax evasion, and therefore G7 became G20, not out of benevolence but out of compulsion. And in that UK summit of G20 leaders, which Dr. Manmohan Singh from India had attended, it was captioned, "The era of banking secrecy is now over." In fact, that was a landmark summit which led to so many developments, which led to a spurt in the arena of exchange of information, including the development of the Common Reporting Standard, CRS, somewhere in 2014, under the aegis of OECD, who have done yeoman efforts towards that subject, as we will see in the later slides. Next slide, please. Now, in this section, I now turn to focus on what have been the historical efforts which have been taken. Friends, these are interesting trivia for you. The earliest exchange agreement, not of tax, but only an exchange of information, this was signed way back in 1843. Look at the visionary nature of these exchanges. This was the earliest one. It dealt with reciprocal administrative assistance, essentially covering registration and inheritance duties and property taxes. There was no income tax those days between Belgium and France. So there is only one Article 1 of this landmark agreement, which I will read now. There will be between the receivers of the registration and the domains, exchange of all the documents and information which can help in the complete and regular collection of the rights established by the laws which govern the two countries or relate to domain interests, they are reciprocally related. Basically, it said that registration by a Belgian tax resident in France of transfer of immovable property located in Belgium will be shared mutually. Pertinently, this agreement is still in force. You can see the kind of earliest exchange they have started. This is about exchange of information to prevent tax/duty avoidance. That's what they started. Then we had a series of bilateral exchanges. Then you had 1907, Great Britain and France, and so on. At the end of the World War I, friends, the League of Nations, the victors, they constituted this league, and one of a significant step was taken in that to try and come up with the what do you now see as the double taxation avoidance agreement. In 1927, the report was published in 4 parts. Exchange of information was one of those important parts. Yeah. But again, that is amongst the League of Nations and left it at that. Multilateral cooperation, actually, the major trend that we can see is in the European Council Directive 2011/16/EU. Of course, now I will talk about OECD and the lot of developments they have done in the subsequent slides, but I will stop at here to tell you the first cross-border effort on exchange of information happened amongst the European Union nations, where they have defined AEOI, automatic exchange of information, as, I read inverted commas, the systematic communication to another member state without prior request, no need to request. And this has to be systematic communication of what? Of predefined information concerning persons residing in other member states to the member state of residence concerned, contained in the tax records of the member state, communicating the information Now, which is retrievable in accordance with the procedures of gathering and processing information in that member state at regular intervals fixed in advance, meaning it has to be periodic. Now, this was by far a very landmark because now you have 27 to 29 states amongst themselves. They established the rules and procedures how the EU member states could enter into cooperation with each other. Again, there they left it bilateral, and over a period of time it became multilateral. And for purpose of exchanging information, which was likely to be relevant for the administration and application of internal laws of member states. Yeah, relating to all their taxes. Income tax was clearly included in that. Next slide, please. And here we now, okay, there are a few more examples of regional tax cooperation. You have Scandinavian countries did something in 1983. Our own India, we had SAARC, Multilateral Agreement on Avoidance of Double Taxation, in 2005. Imagine, I sometimes wonder what would have happened under this when we have asked, because SAARC meaning India, Pakistan, Nepal, Bangladesh, Bhutan, and Maldives, and Sri Lanka, of course. So if I were to ask a tax evader or a known militant who has, who has been found to be evading taxes and that money is used for all nefarious activities here in India, if I make a request through this SAARC Limited Multilateral Agreement on Avoidance of Double Taxation to Pakistan, would it have fructified or not? I'm not sure. It's for the government perhaps to throw light on. But we did have an overarching framework. An enabler was no doubt there. West Africa, they did certain things. The Americas, the South Americas, they have had the Inter-American Center for Tax Administrations. That was something in 2015. Next slide, please. These are certain examples of regional tax cooperation. However, friends, it is the OECD which has been the steadfast anchor of promoting tax transparency standards. They have been the standard setters when it comes to exchange of information. They have done yeoman efforts. For example, they have been the forum who conducted analysis and produced reports. They provided inputs on the level of cooperation received from jurisdictions for exchange of information. They acted as interlocutors for G20 leaders. Yeah, they developed non-binding standards which showed the way ahead rather than imposing them on jurisdictions. They also worked in coordination with governments in capability building to implement their action plans and help them comply with the desired standards for that exchange of information. Yeah, you had this global OECD. They have, of course, done a lot of developments, which I will enumerate in the ensuing slides. But two landmark events do stand out. The establishment of the Global Forum on Taxation in 2000, which was pursuant to the OECD's report, which was against eliminating harmful tax. It was for eliminating harmful tax practices and promoting global tax cooperation. That was somewhere in 1998. Pursuant to that, this forum was launched, and it played a major role in the establishment of EOI standards, which we have implemented today. And then we have, of course, the Global Forum, again, under the aegis of OECD only, which was launched specifically on the aspect of promoting transparency and exchange of information for tax purposes. We'll see all that in the subsequent slides. And the next slide, please. These are running through some developments which have been made. 1977, they made the first recommendation for tax avoidance and evasion and through exchange of information. Then we had some guidelines coming in 1980. Systematically, you will see, friends, step by step, they have shown they have been the torchbearers when it comes to exchange of information standards evolution is concerned. Next slide, please. 1992, they brought out the first standard magnetic format, how to report through computers. Then how do we use tax identification numbers? 1998, I just mentioned that they brought out this seminal report, Harmful Tax Competition and Emerging Global Report issue, pursuant to which they brought out that recommendation also on counteracting harmful tax competition. Yeah, harmful tax competition, meaning that is the race to bottom that I alluded to some time back. Nations compete as to how to promote tax secrecy. If that happens, then it is detrimental to global trade because it is distorting information flow, which is a must for evolution of a thriving global market. That is vitiated, and therefore that had to be tackled, and tackled urgently. Next slide, please. They, of course, developed various agreements, model memorandum of understandings, conventions, culminating in the AUOA standard 2014, which we will see ahead. Next slide, please. Well, the most important thing was for this Global Forum for Taxation that got renamed later as Global Forum for on Transparency and Exchange of Information for Tax Purposes, the Global Forum as we call it. In 2009, it became the world's premier multilateral body within which the area of transparency and exchange of information for tax purpose was and is still being carried out. How they brought about this, how they acted as a harbinger of change is they had this peer review process, unobtrusive, non-binding, non-mandatory. But if you are a signatory to our framework, we will make you go through this process, and then you will see for yourself the results, and then you have to improve. So they followed a step-by-step process whereby they would have each participating jurisdiction. They will provide detailed description of their operational framework, what they had in place to ensure effective implementation of the AUOA standard. And then the peers were invited to provide inputs in relation to their experiences. How was your experience? Was it smooth? Did you get the desired information on time? Did you get it in the desired format? Or was there any stumbling block? And then there would be an assessment of that. That would be an independent 13-panel experts from peer jurisdictions. They analyze this information provided and other relevant information, such as that found in the public domain. And once this process was done, a view of the situation was established, and the AUOI assessment panel will prepare a short report on each jurisdiction. This report will then be provided to each jurisdiction for their comment before they are submitted to the peer review group for discussion and approval. And next slide, please. How did India fare in this? In fact, India was had a stellar role in this peer review group. In fact, it was vice president from 2009 to 2013 of this group. And we committed to the CRS somewhere in 2017, meaning we will provide automatic exchange of information. And now we have been proactively doing to more than 85 jurisdictions now. In 2021, that's the last publicly available data that I have. So India had a rating of in place but needs improvement rating. And that was primarily because of some two core requirements were there. One is international legal framework, the DTAs, etc., which already were in place. So therefore, we have an in-place rating there. But insofar as certain domestic legal frameworks where we have an in-place but needs improvement rating, mainly because certain of our entities we had classified as non-reportable jurisdiction. These jurisdictions need not provide information. Their information need not be provided under the CRS. Whereas AUOI gold standard, the CRS states that needs to be provided. I think over subsequent time, we have ironed that deficiency out. Yeah, please proceed. Next slide. Now, these are certain positives which have emanated. I think SP Singh sir talked about it at the opening. So it has led to this concerted, coordinated effort amongst jurisdictions, has led to huge unearthing of tax revenues, almost to the tune of 112 billion as per that slide. There are almost 120 jurisdictions now who have begun automatic exchanges, and data on more than 125 million accounts today, over euro 15 trillion assets that is being exchanged through the process that has been set in place. That is the positive impact of the Global Forum and its efforts. Next slide, please. At this stage, I will now turn to the technical aspects of our discussion today. The Article 26, we have had this Article 26 in the Model Tax Convention. Kind to the next slide, please. Somewhere in 1963, it found its way into the Double Taxation Avoidance Agreement. It was amended regularly. 1977, it got amended. 95, 2000, 2005, it got amended. Even in 2017, there was some amendment to this important article. This article deals with exchange of information. It has 5 limbs to it. The OECD Model Tax Convention. Broadly, it states that competing authorities, okay, the words used in double taxation avoidance agreements, DTAs, will be contracting state and the other contracting state, which means one jurisdiction and another jurisdiction, India and the USA. So competing authorities of the contracting states, competent authorities of the contracting states shall exchange such information as is foreseeably relevant for carrying out the provisions of this. So as is foreseeably relevant, friends, there is India-Germany treaty, if I recollect, where, India-Australia treaty, for example, where they still will relate to competing authorities shall exchange such information as is necessary. So earlier the word was necessary, which got amended, later modifications to foreseeably relevant. Somewhere at the beginning also I made a mention about it. So therefore, as practitioners of international tax, all of us have to pay attention to the wordings of any treaty pairing that we are set to or called upon to evaluate. So treaty wording is important. Here I am referring only to the Model Tax Convention, which retains, which has done away with necessary, which is a narrow sense of the word, to foreseeably relevant, which is a very broader term in that much. The assessing officer need not establish it is necessary. This information is necessary for my assessment purposes. It is foreseeably relevant. I do not know. It may be needed also, but please give me. Yeah. Now, so the competent authorities of the contracting states shall exchange such information as is foreseeably relevant for carrying out the provisions of this convention to the administration or enforce of domestic laws of political subdivisions or local authorities, insofar as the taxation is not contrary to the convention. Broadly, 26(1) says competing authorities will exchange information as is foreseeably relevant for carrying out the provisions of this convention, which is avoiding preventing double taxation and avoiding tax preventing tax avoidance. Next slide, please. Article 26(2) that talks about the confidentiality of the information. So the information which is received must be confident, secret, just like how you will under your domestic tax laws. Its disclosure is permitted only to persons who are connected to assessment or collection, enforcement, prosecution, or appeals of related to the taxes, judicial forum, or tax authorities only. It can also be given to outsiders if provided that it is in writing from the other tax jurisdiction. And it will be only used for the specified purposes. If it is to be used for any other purpose, there has to be a specific permission for that. Yeah. So confidentiality is the core of Article 26.2, 26.3. It is talking about, next slide. It talks about certain limitations to exchanging information. I mean, states cannot be asked to carry out certain administrative procedures which are variant with its laws and its administrative practice. You cannot expect India to do certain acts which it cannot do under its domestic tax legislation. Yeah, this is the Model Tax Convention. Yeah, or to supply such information which is not obtainable. Maybe time barring, it has become time barred, or certain information which is confidential, or would disclose any trade business secrets. Those information we cannot share. So the Article 26.3 circumscribes some limit to how much of information can be shared. Next slide, please. Now, Article 26.4 will talk about what to do when the information request is received. Upon request from another contracting state, a state shall use its information gathering measures to obtain the requested data, even if it does not require it for its own purposes. Earlier, one of the stonewalling tactics, like Shekhar Chitlesar was talking somewhere back in his opening remarks, if someone, I do not need this information for my purpose, so why I should collect it for you? Those were stonewalling tactics, no longer. Then again, this limitation can never be construed to allow a contracting state to decline supplying information solely because I do not have a domestic interest in that. Okay, so still I have to give. If I have signed up on this kind of a model, I am supposed to share information. 26.4, what to do when the, next slide please. So 26.4 was what to do when the information request is received. 26.5 is, well, there is no limitation only because the information cannot be withheld only because it is held by a bank. I cannot give you because it is held with a public institution, a financial institution, or someone acting in an agency or a fiduciary capacity. One second. Second, I'm trying to come back to the slides. Yes. Yeah. Next slide, please. Do I have anything else to talk to you about this? So, while India has had Article 26 in its various tax, double taxation avoidance agreements, but there have been certain limitations to it, chiefly because the wheel of banking secrecy was invoked. Jurisdictions would often cite their domestic banking privacy laws, which would criminalize sharing of information, and therefore they will decline to entertain requests. Next, we also had the problem of requested jurisdiction not obliged to share information, which was not obtainable under its domestic laws. I cannot collect, so how can I give you? Then there was, please remember friends, we are talking about multiple geographies, multiple jurisdictions, and multiple tax concepts. Here, there are certain jurisdictions which have protection of individual civil rights under their domestic laws. For example, India, Germany. In that, information to the taxpayer about personal data being exchanged has to be given. So if India is requesting for some information from about a person, about its taxpayer from the government of Germany, the government of Germany is duty bound under its domestic law to make this taxpayer know that India is asking for some information, such and such information about you. That naturally will alert him. But that's how the domestic laws of certain jurisdictions are, because world over the concepts are not same. Also, there could be privileged communication between lawyers and their clients, which cannot be divulged under laws of certain jurisdictions. This was also touched upon at the opening. In case of some jurisdictions, they will not provide for the exchange of information for all tax crimes. Cases such as non-reporting of accurate information for domestic tax purposes. Sometimes some of the jurisdictions say they are not criminal. And if it is not criminal, how I can give you the information? Yeah. And last but not least, the Article 26 encountered a major challenge because of non-reciprocity. I am ready to give, but you are not ready to give me. Right? Non-reciprocity. Jurisdictions could refuse earlier to provide information where requesting jurisdiction itself was precluded by law from either obtaining or providing the requested information. Yeah. In which case, the requested jurisdiction was looking at an unreasonable request. So now suddenly we have to sit in judgment on what is reasonable, what is not reasonable, and all that. So therefore, whilst we always had this Article 26 as part of our a very significant or important, potent tool of collection of information for the purposes of proper implementation, purposive implementation of the tax treaty, yet we have in the past encountered significant challenges. That led to us signing various tax information exchange agreements. Typically, these TIEAs have been signed. The format is in front of you, a 10-part or 11-part general template. India has signed them mostly with tax havens. So as of September 22, we had about 21 bilateral TIEAs with Argentina, Bahamas, Bermuda, British Virgin Islands, Macau, Guernsey, Isle of Man, Marshall Islands, Saint Kitts, and so on. These are all, the names would ring a bell as a tax haven. Yeah. So India has also signed, apart from DTA, we have also signed TIEAs. Yeah, that's the point I was trying to make. Next slide, please. It's 5:20, 5:17 now. We have another 3 blocks to go, and I think I will end about 5:35, 5:40. That's okay. CRS, the global standard. Yes. Please proceed. Next slide. This came in 2014. In fact, friends, present Indian Finance Minister, Madam was there that day when this historical milestone was reached, May 6, 2014, the Declaration on Automatic Exchange of Information in Tax Matters. Friends, now you will be able to recollect in the Indian context certain amendments which came by. Are you able to recollect Section 285BA got amended? I will share at the last, I will do touch upon. Then we also brought in the Black Money Act, Black Money Undisclosed Foreign Income or Asset Act 2015. All this came after this because now we have declared that India will receive and supply, exchange automatically the information in tax matters. Yeah. Next slide, please. And these are all enablers. Broadly, the concept was that we will have a common set of reporting standards. First, we have to determine who is to report, the reporting financial institutions. That's where in the earlier slides, especially India's performance in the peer review format, you saw we needed some thing to be desired. Why? Because we said certain reporting financial institutions, we classified certain entities as not reporting financial institutions, whereas the CRS said they are, and which includes banks, custodians, mutual funds, investment entities, insurance companies, and so on. Right. So that was the first pillar. The second pillar is what are the reportable accounts? Accounts held by non-residents, individuals and entities, plus beneficial owners. Now, the concept of beneficial owner itself is a fascinating subject. It has evolved because of judicial precedents worldwide in very, very various forms and manifestations it has taken. And the CRS has tried to standardize to some part the concept of beneficial owner. These are all to be reported. Now, how will these reporting RFIs, reporting financial institutions, how will they gather the data about these guys, the reportable accounts? They have to do some due diligence procedures. Now, how will you do that? To tax residency through self-certification, and all these things have undergone a sea change. The way the financial institutions collect the information. Now, what is the information to be reported? The most important $1 million question: name, address, tax identification number, account balance, sale proceeds, dividends, interest. There are a host of fields which have been provided. Next slide, please. That's right. The CRS. So today, more than 100 countries, we are exchanging information. FATCA, the precursor to this. FATCA was Foreign Account Tax Compliance Act. It was specific to US. Anyone dealing with the US financial institutions, the US financial institutions had an obligation to report to the IRS. So FATCA is US specific, CRS is global. We have a very wider participation here. Yeah. Core commitments, no need of now reciprocity, etc., because everything is now multilateral. We have a multilateral convention which takes care of the reciprocity and other concepts. So what were the prerequisites? We had to have a strong domestic legal framework which permitted exchange of information, and that also had to translate these regular reporting and due diligence procedures rules we will see in the last slide in the Indian context. Then there has to be a legal basis for exchange. We have it in India under section 90 bracket 1 bracket C. Then we need to have proper IT and administrative infrastructure. Administrative, we already have the learned CBDT. The IT infrastructure, we need to have proper servers. And last but not least, the data which comes through this information exchange flow has to be confidential, maintained confidential. It is of paramount importance. Otherwise, there will be a lack of or a breach of trust amongst the jurisdictions involved. Next slide, please. Yeah. Next slide, please. Now I turn to the last block, which is how does this FATCA and CRS, how have they been, how has India tried to implement them? Friends, this also serves now to recap the importance of exchange of information. It is not a old news I am projecting on the screen here. Just the day before, and this caught my eye, and therefore I said I will present it. This is a public information available on the online media. It's in the news in the context of Pakistan. So their defense minister has claimed the country's top bureaucrats have done massive corruption and international money laundering. Billions of dollars in illicit wealth have been moved from Pakistan to Portugal. Friends, we are talking of exchange of information, not vintage. It is current, live. So Pakistan now feels the need to get this information from Portugal. And of course, it has to therefore shape up in terms of EOI and then the CRS, and then we have FATF. In fact, Pakistan is a victim of, or perhaps it is under the spotlight of the FATF once again, Foreign Account Action Tax for Financial Action Task Force, which had grey listed Pakistan for quite some time. And here you are. It's a live case of money laundering happening, illegal money crossing borders, stashed abroad, and the local jurisdiction, in this case Pakistan, trying to retrieve the ill-gotten wealth and give tax justice to the culprits. So this is a very live issue. Go to the next slide, please. I will now look at the Indian context. That's right. Now, the power to implement exchanges of taxpayer information, is derived by the Indian Income Tax Authorities from Section 91C of the Income Tax Act 1961. This provision will permit the Indian central government to enter into any agreement with a foreign government for exchange of information for the prevention of, evasion or avoidance of income tax chargeable under this act or under the corresponding law in force in that country or specified territory, as the case may be. Specified territory, there are certain provinces like Faroe Islands, which is not which is a part of Denmark, but it is still not neither a sovereign part, but at the same time, it is not, it is semi-independent, I should say, with which India has had a territorial extension agreement. So it could be a specified territory also, as the case may be, or investigation of cases of such evasion or avoidance. And that's how Section 285BA, specified financial transactions, SFTs. So Section 285BA of the Act will bring in an obligation on the part of certain persons who are specified under that, obviously, to furnish a statement of financial transaction or reportable account. In our case, it will be both. The reportable account will also come in. This section was first introduced into the Act with Finance Act 2003 with effect from April 1, 2004. At that time, the stipulation was to furnish an annual information return. Now, this is a powerful tool. 2015 we have amended, we will now see. So it has, why it is powerful? Because it is providing the learned income tax department with vital and critical financial information from certain specified persons, such as recognized stock exchanges, the RBI, the depositories, the authorities in charge of registering immovable properties, and so on. So they have to give this annual information return in respect of the specified financial transactions which are registered or recorded by them, and which are relevant and required for administering the purposes of the Act. Now, in our context, in the context of AEOI, Automatic Exchange of Information, with a view to facilitating effective exchange of information in respect of residents and non-residents, the said Section 285BA that was amended, I told you, in 2014, with effect from April 1, 2015, so as to provide for furnishing of the aforesaid statement by a prescribed reporting financial institution, RFI. That was the concept you saw as a pillar of the CRS, right? So a prescribed RFI in respect of a specified financial transaction or reportable account to the prescribed income tax authority. The time and form and manner of reporting and all have always been prescribed thereafter. Go to the next slide, please. The purpose or the memorandum which brought in this bill, this amendment, the Finance number 2 Bill 2014, it explained that the purpose of this amendment was to facilitate effective exchange of information in respect of residents and non-residents. Friends, at the end of this broad 1 hour, broadly 1.5 hours of session, we have now seen from where we were to where we have now come. Hitherto, letters rogatory were being used to capture or collect information, and it was always stonewalled, and it was a very less chance of information getting available unless it is a government-to-government exchange, such as the Liechtenstein papers which happened, and there are certain case laws which have come out in the public domain, and hence we know. Today, we have reached a stage where it is ingrained in our Act itself, the need to exchange information through Sections 90 and now Section 285BA mandating the push mechanism. We have to push this information from prescribed RFI, reportable financial institution, and the contents of the report, what are needed to be reported, how the due diligence has to be done, all that has been prescribed. And this push mechanism is well reciprocated by a pull mechanism through the worldwide network of jurisdictions pushing their information so collected, because world over we have tried to standardize the data which needs to be exchanged. And therefore, when I give some information, I naturally expect reciprocity and the opposite jurisdiction also to share the same information. That's how the stated purpose and intent of any tax treaty that we have, which is to avoid double taxation and to prevent tax avoidance, then only that will be fulfilled. And therefore, we have made giant strides in the field of exchange of information is concerned. Next slide, please, which will actually give out the a broad about what I have just covered. And who has the obligation, who must report, what are the transactions covered, what are the timelines. Form 61B, it is annual affair. By 31st of May, it has to be exchange, the sub-registrar, so on and so forth. Post offices. Next slide, please. And there are, of course, penalties for non-furnishing of this information or inaccurate particulars. These are the rules which have been embedded, which give more clarity on the terms used, the definitions which are used in the Act 285BA, what is a prescribed RFI, then what are the reporting obligations, what are the fields to cover, how are the due diligence procedures to be implemented. Basically, since it is a cross-governmental, cross-jurisdictional exercise spanning multiple jurisdictions, they have tried their best to standardize it. Because like I said at the beginning somewhere, not all jurisdictions will have same framework of various things, including definitions, including the methodology, including approach. Like I said, certain tax crimes are not tax crimes in other jurisdiction. One may have it, one may not have it. And therefore, the need was felt to standardize. Here we have trying to codify within our income tax rules certain set of standardization. Yeah, these all have contributed. Next slide, please. These all have now contributed to a well-established system of exchange of information. Friends, with this, I come to the last block. Looking ahead, what do we see? The future of exchange of information, where it is, we have come a long way, certainly, friends, as you will agree with me by now. From the days of shooting in the dark to having certainty as to what information I will get by when and how it will be disseminated to the last mile learned income tax officer. How will it be made available to him? Now, looking ahead, I feel artificial intelligence could come in, perhaps now that the learned CBDT has got the information on May 31st, then perhaps it will sort out the information in June, and by well before the tax assessment deadlines, which have been ever so shortened. So the local tax officer will need to have some kind of at least the basic information which he may perhaps use with appropriate sanction for the better implementation and administration of the Income Tax Act 1961 is concerned. I also feel EOI will now have to also take into account the emergence of crypto assets which have come by, and therefore perhaps crypto reporting must also someday come into the legal framework. Rules may need to be amended for that, perhaps, unless they are already done. Because again, this is cross border, and crypto has already colored or layered the currency or the physical money as such, and therefore it is a very important information for the local learned income tax officer to have, I'm sure. Next slide, please. Perhaps looking ahead, we also feel there will be increased cooperation between, as the newer technologies, the newer schemes in tax evasion might be discovered in various jurisdictions. I'm sure there will be that much interest for other jurisdictions to try and understand and take preventive measures within their fold. Looking ahead, perhaps I may also hazard a guess that it may not just restrict to tax anymore. Remember 1843, India, Belgium and France signed the exchange of information on immovable properties. Perhaps the time has come once again full circle. We may need to look beyond tax. It may be for assets, illicit assets, crypto assets, and there may be a case for jurisdictions to unite in this rampant fight, in this massive exercise and never ceasing exercise to fighting rampant tax evasion and newer evolving forms associated therewith. I am sure, in passing, thereby, that the exchange of information is a concept which is here to stay. The tax jurisdictions have already tasted success, and therefore, they will look forward to ways and means to enhancing tax cooperation through EOI in their gentle nudge to effecting positive behavioral shifts in voluntary tax compliance. That's the last slide I think I have. Any other slide? Last slide, please. So with this, friends, I will pass it back to the moderator. Once again, I thank all of you for a patient, hearing. I hope I was able to throw a primer or some kind of insight on the concept of article or the concept of exchange of information and try to derive a link. Firstly, what is the need for it and how it has evolved over the ages from 1843 to date, and what has been the role played by the OECD as the path bearer on this important front. And then we moved on to Article 26, which was the Model Tax Convention article that we had, how we have it in various treaties that India has. We also saw some differences that India has in treaty to treaty, therefore imperative to study each treaty pairing. And finally, we also took a look at the CRS, moving on, the common reporting standard, what needs to, who is a reportable financial institution, what are the reportable accounts, how are the due diligence procedures to be implemented, and so on. And then we finally also took a look at the Indian extent framework on exchange of information, which is Section 285BA of the Act and Rules 114F to H of the Income Tax Rules 1962. With that, I will only part with this adage, what has been in front of you. Just one slide before, please. The OECD has, so as the world becomes increasingly globalized and cross-border activities become the norm, tax administrations need to work together to ensure that taxpayers pay the right amount of tax to the right jurisdictions. Remember, base erosion and profit shifting project, BEPS project. This is clearly a leaf out of that. The enhanced cooperation between tax authorities through AEOI is crucial in bringing national tax administration in line with the globalized economy. With that, I'm firm that AEOI is here to stay and evolve. Thank you so much. I now hand it over to the moderator. We have 20 minutes of Q&A as the chairman sir wanted. Sneha.
Thank you so much, sir. In this session,
stop presenting, please, Kailash.
So thank you so much, sir. So in this session, we have seen how the exchange of information has evolved from a mere clause in tax treaties to a powerful global mechanism. It could be for combating tax evasion, promoting transparency. So it is basically strengthening the integrity of our financial systems. You have walked us through the legal framework, the different types of exchanges, success stories, the challenges, and what lies ahead in the increasingly connected world, all through your research and experience, sir. So you have also showed us how India has positioned itself in the global forum on AEOI. So more than 100 jurisdictions are now up for this automatic exchange of information, and we see that this is evolving area of taxation that we all need to keep eye on. So thank you for such an enlightening session, sir. Further, let's move on to the Q&A. We have few questions for you, sir. So this one question which our member would want to know, in a should the developing countries push for more reciprocal exchange of information arrangements, even if they currently lack capacity to match the developed nations reporting?
Okay, I think yes, we have to. I think the OECD, and that's what I touched upon, they have, through the Global Forum, made concerted efforts to uplift the capabilities of the developing nations, bring them on to par with the developed nations, and then on an even keel facilitate the exchange of information. Therefore, it is the OECD which has piloted and then pioneered this effort and continues to do so even now. I am also aware of World Bank and other such institutions who are doing some work, excellent work in this field, trying to uplift through official exchange. We will send our income tax officers with knowledge to foreign jurisdictions and let them be aware these are things going on, these are things that you need to improve, and so on and so forth. That's how we will come up to the standards of the developed nations, so-called developed nations. Please remember, in this war, ever continuing war of tax evasion, even a powerful nation with huge, you must be thinking, United States of America would have such a well-developed tax legislation and framework. Still, they were at the receiving end of so many scandals. Why? So therefore, I would think the success of any such exchange of information is not so much as having a robust law in place. It is the political will that is reflected through the G20. I am aware, and I have covered that in my book. Every G20 summit since 2009 has devoted a topic specifically for exchange of information. Imagine what a political leader like Mr. Modi, he is catering to the world at large in front of him. What has he to do done to devote something to exchange of information? It's a very chota topic in front of him, but that shows the importance of exchange of information, what these political leaders have decided, and it is forming part of the overall leaders' communication. Every time at the end of the summit, they give a communique, and exchange of information has formed a consistent place in all these summits. That speaks for volumes how the trend is world over. Naturally, to answer that gentleman's question, it must be, or that lady's question, it must be developed nations have to push for more knowledge wherewithal. And I think the answer is they can approach the OECD to get that.
I would like to add something here.
Thank you,
It's
sir.
Yes,
very,
Sita.
very excellent question. The developing countries are always under pressure from the investment from outside. They do not want, their accounts to be audited in the same way in which, the authorities in developing countries will like. And the only fear which they put is that they will move their investment. This has been one of the reasons why, for a long time, the tax enforcement has been lax in many developing countries. But gradually, the developing countries are realizing that the money is flowing from their exchequer to the developed countries' exchequer without a considerable or without a significant, growth in their own country, in the developing countries. And gradually, the developing countries are improving their infrastructure, which invite investment. So they are strengthening and improving all those factors which are good or will be good for the investments to come in their own country. And now the developing countries, you take the example of India, which Natarajan Sahab has explained so nicely, are strengthening their exchange of information only because we have now, investment which on the basis of, the market and opportunity to invest and flourish. We are enforcing the tax system, and exchange of information is a very, very vital cog in the wheel. So the developing countries have moved away from a period where enforcing law was considered detrimental to the investment to the present regime where enforcing the law is a part of the development process.
Well said.
Thank you, sir. Thank you for your insights on this. Sir, since you're already joined us, could you also put more insight on how this is practically evolving at the end of revenue authorities?
Mr. Natarajan has shared the mechanism which has been incorporated in our Income Tax Act to 85 BA rules and all those, where we are collecting information. And he has rightly mentioned that India is also using AI to analyze or go through the huge amount of information which we are collecting. The government is collecting through various sources, and those are being used. For sharing information with other countries, and in return, the informations are coming, and they form very vital source for picking up the cases for scrutiny, because we are also moving away from a regime where the punishment of prosecution was considered as tool for tax enforcement to a regime where use of information right in the beginning is making the taxpayer to disclose, so that the voluntary compliance is improving. And this knowledge that the transactions can be accessed by the Indian authorities from the foreign governments is very important for improving the voluntary compliance among the taxpayers. So, and if I go back in history when I used to be in the department, that time, we didn't have such an advanced, the infrastructure, IT infrastructure. But yes, even those days, information used to come on a specific request and also as automatic exchange, which were used for unearthing many tax evasion cases. So it has already been where it was not so developed mechanism that the information were coming and were used for detecting evasion. And now, this, as the system has improved, the incidences of identifying cases of tax evasion has improved significantly.
Okay. So, what could be the unintended consequences of aggressive EOI use, like when you're overly aggressively using the exchange of information?
So far as EOI is concerned, it cannot be aggressive, because EOI itself means that you detect something in India for which you know that the source is in some other country, and you need to get that information. You just take the example that suppose some businessman in A state is having another business connection in state B in India itself, and want to get the information from B state. It is something like that. The world has become a bigger country, you can say, where different parts are now so interrelated that you can get the information. So exchange of information as such, there can be delay, but it cannot be aggressive.
Thank you, sir. This question is for Karthik sir. Sir, could you explain the key differences between the DTA-based EOI clauses and TIA's exchange of information?
So DTAs are generally signed between two sovereign jurisdictions, and TIEAs are often signed with certain territorialities. For example, I named some of them during my presentation. Saint Kitts, which is a part of the United Kingdom. Saint Kitts, Bermuda, and so on. India has had a separate TIEA with these principalities. However, with United Kingdom, as such, we have a DTA. So that is the difference. DTA is and Article 26. The almost the kind of flow and the text will be almost similar as I projected. A model sample TIEA is concerned. However, having said that, DTA is covering exchange of information as one part of it, whereas it is also allocating the tax collection right between taxing rights between jurisdictions. A TIEA is specifically for exchanging information about tax is concerned from one jurisdiction to one. That is the difference. DTA is more broad-based, TIA is restrictive.
Thank you.
To explain, to take it further from what Natarajan Saab has said, that suppose there is a country where there is no taxation. So there cannot be a double taxation avoidance agreement with that country. But we know that our people go and invest there, and we want information from them. So double taxation avoidance agreement, as it is not there, is not useful. So in such a situation, I mean, entering into an agreement with those jurisdictions or the countries is the only way possible for getting the information. So it has been developed by the OECD, and it has the blessings of G20, and therefore it has become effective. It was not there, I mean, earlier. Yeah, Natarajan Saab, you want to say?
No, sir. Kindly go ahead.
Yes, Neha.
Back to you, Sneha.
Yes. So I think with questions, that's all for the questions, sir. So if you have any closing remarks regarding this session, please share with us your inputs.
Sure. So, I mean, I have seen Mr. Natarajan Sahab working on the book on the exchange of information, and the same level of involvement and research has gone into the today's presentation, and it is a nice summary of not only the book but the developments which have happened after the book was published. And I'm sure the people would be very much benefited by what has been discussed today. There may be one question which may be bothering people, that what we have been talking is exchange of information between the authorities. What is there for the taxpayer? I mean, is it only a tax avoidance measure, or can it be, I mean, ever by any stretch of process be used by a taxpayer? That may be one question, I mean, which should bother, I mean, everyone to have the interest in this subject. And it's only, I mean, my very high level, I mean, thought about this, that yes, it can be used by taxpayers also. That suppose there are certain transactions which have happened, or a payment is received or a payment is made to the foreign jurisdiction, and the foreign jurisdiction, the entity in the foreign jurisdiction is not providing the necessary information to the Indian, I mean, businessman, Indian taxpayer, which can be produced before the tax authority to justify the transaction. There can be, I mean, many situations. Now, the exchange of information is one where this can be used. Let me give you a very, very, very practical example. Suppose Indian company shows that there is a purchase of X amount from country A outside India. And the tax authorities say that they doubt that whether it has been purchased or not. It can be, I mean, the software or thing like that, for which there is no custom clearance, so there is no evidence of that passing the border. In such a situation, the burden is on the Indian taxpayer to show that this purchase had taken place. Now, how will it do? Now, it can very well go to the tax authorities and try to use the exchange of information. Saying that, I mean, this sale was made. So, obviously, if a sale was made by the foreign company, then that must be reported in their books of account because it is income in their hand and it is an expenditure in the hand of the Indian entity. So, obviously, it will attract or it will be useful for the foreign jurisdiction to have that information, whether that income has been avoided or not in their own jurisdiction. So, exchange of information is not only for the purpose of taxing or investigating an Indian taxpayer, but can be used for the benefit of the taxpayer. This is, I don't think that any taxpayer has used this, but this is something which, if it is used, I mean, should be possible. My very high level thought. I mean, in fact, I have not tested it. No request came to during my time, but yes, now during those days, I mean, cross-border transactions involving India were very few. Now it's almost like domestic transaction. So similar cases may arise or are possible. Yes, Neha. So that's one aspect which I think, I mean, may be relevant for the Indian taxpayers. So, Natarajan sir, will you like to expand anything which you feel that you would like?
Maybe part of the updated edition that we are about to bring in the book.
So, would you like to explain any item which you thought that you like to highlight to the participant today?
I think since you touched upon at this last piece of yours, where you sought to touch upon what is it in it for the taxpayer and or a practitioner, rather it seems devoted primarily towards the authorities. I think today's session was also intended to make our fellow practitioners be aware of the reach of and the extraterritorial reach of exchange of information efforts, where all they have permeated, how all they would be used or likely to be used, and to that effect try and demonstrate through a voluntary compliant behavior and helping their clients in reporting the right amount of disclosures and the amount of tax to be computed. Now that will be one of the important takeaways from this presentation that we have, our Learned CTAX has conducted. So that was one important point that I wanted to register.
Thank you. So let me thank Natarajan Saab. I mean, he is very I mean, I'm sure everybody must have seen the depth or width of his knowledge and the way he puts that. I mean, it's good to have the knowledge, but how you put it to the people who are not so expert or like him in a very simple language, explaining very finer details. It's a hats off to him for such a nice presentation. And I also commend, I mean, the way Sneha has moderated the session. She has been on the top of the subject, shows how she has done the homework and come up with a very nice summation of the points. And I would feel to, in my duty, if I don't thank the chairman, Sanjay ji, and Chitle Sahab, Aparna and her team, which has organized, I mean, Prachi and technical support team, who have organized very smooth conduct of this webinar. Thanks to all of them for the nice work done. Thank you.
Thank you, SP sir, for your valuable inputs throughout the session. And I would like to express our gratitude even to our today's speaker, CA Karthik Natarajan sir, for sharing his insights from his growing importance of exchange of information. So your clarity in explaining the complex concepts, your practical perspectives have truly enriched our understanding on this critical subject in international tax today, sir. As SP sir has already mentioned, a heartfelt thanks to our chairman and our vice chairman for helping us with their continued guidance on these sessions. We're also grateful to all our respected members, participants, and audience for joining us for this session and making this more meaningful and impactful. I take this opportunity to thank Committee on International Tax for giving me this opportunity to moderate this unique session. Special thanks to the organizing committee, the technical team, the support staff who are behind these sessions and where their efforts are making them smooth conduct of the event. Thank you, everyone.
Thank
Thank
you.
you, everyone.
Bye. Bye. Yeah, please. Thank you.